Okay, so this is for the subject strategic business analysis, and the topic for this one is pricing methods. Okay, so there are four that will be discussed for in this particular video. We have cost-based pricing, and then demand-based pricing, competition-based, and then break-even analysis. Okay, so first we have cost-based pricing. This is from lumenlearning.com. Okay. Cost-based pricing, this involves calculating the cost of the product and then adding a percentage markup to determine the price. Okay, so you have your cost of producing the product or service, and then you add a markup, and then after adding the markup, you get the price. Essentially, the markup is your profit, okay, from that. Learning objectives, analyze the use of cost plus pricing as a pricing method. Essentially, cost-based and cost plus pricing, the same. Key takeaways, cost-based pricing is the easiest way to calculate what a product should be priced at. And this appears in two forms. You have your full cost pricing and direct cost pricing. In full cost pricing, it takes into consideration both the variable and the fixed cost, the share of the products in the fixed cost of the company, and a percentage markup. Okay, in direct cost pricing, only the variable costs are considered plus a percentage markup. Okay, cost plus pricing, a pricing method used by companies to maximize their profits. Okay, because they already see how much markup or profit you're going to earn for each unit of the product. The firms accomplish their objective of profit maximization by increasing their production until marginal revenues equal marginal costs, and then charging a price which is determined by the demand curve. Cost plus pricing is used primarily because it is easy to calculate and requires little information. So as long as you have information on how much cost has been used to produce a product or service, then you just add the markup and voila, you get the price. Key terms, you have your markups, the difference between the cost of a good or service and its selling price. A markup is added onto the total cost incurred by the producer of a good or service in order to create a profit. Variable cost, the amount of resources used that changes with a change in volume of activity of an organization. Essentially, it's directly related in the production of the product. So you have direct materials and then direct labor normally. Okay, and then you have your rate of return. Rate of return is known as ROI, return on investment. Rate of profit, or sometimes just return. It's the ratio of money gained or lost, whether realized or unrealized, on an investment relative to the amount of money invested. Okay, so essentially the return, how much you're getting after spending a certain amount of money or on your investments, right? So you have your rate of return. Cost plus pricing is the simplest pricing method. A firm calculates the cost of producing the product and adds on a percentage profit to that price to give the selling price. So this appears, we've read this. The other is direct cost pricing, which is variable cost plus a percentage markup. This one is used only in periods of high competition, as this method usually leads to a loss in the long run. Okay, this method, although simple, does not take demand into account, and there is no way of determining if potential customers will purchase the product at the calculated price. Okay, because you have to consider other factors as well, like price competition, and then you have your demand-based. Is there a demand for this product? Because if there's low demand, then price will go down, right? Cost plus pricing method used by companies. There are several varieties, but the common thread is that one first calculates the cost of the product, then adds a proportion of it as a markup percentage, okay, 20%, 25, 30, 50%. Basically, this approach sets prices that cover the cost of production and provide enough profit margin to the firm to earn its target rate of return. It is a way for companies to calculate how much profit they will make. So cost plus pricing is used primarily because it is easy to calculate, requires little information, and therefore useful when information on demand and cost is not easily available. Normally, this is also used for buy and sell products. Okay. So how much you bought a particular product, you just put a markup on it, and then you sell it again. Okay, because there's not much addition to the product. It's already a finished product. Okay, this additional information is necessary to generalize accurate estimates of marginal cost and revenues. However, the process of obtaining this additional information is expensive. Therefore, cost-plus pricing is often considered the most rational approach in maximizing profit. This approach relies on arbitrary cost and arbitrary markups, right? Second one is the demand-based pricing. So this uses consumer demand and therefore perceived value to set a price of a good or service. Okay, you're only going to sell the products when they are in demand. Okay, when customers want them. The takeaways. Demand-based pricing uses consumer demand, perceived value to set a price of a good or service. Methods of demand-based pricing can include price skimming, price discrimination, and yield management. Price point, psychological pricing, bundle pricing, penetration pricing, price lining, value-based pricing, geo and premium pricing. Okay, so these are different types under it. Okay, pricing factors include manufacturing cost, market location, competition, market condition, and the quality of the product. So those are all the factors that can be taken into account when setting the price of a product. Price skimming, a pricing strategy in which a marketer sets a relatively high price for a product or service at first, then lowers the price over time. It is a temporal version of price discrimination or yield management. The yield management method of analyzing information to forecast market conditions and implications for the firm. Okay. Demand-based pricing is any pricing method that uses consumer demand based on perceived value as the central element. So if a customer or if the customers think that this product is worth it, that it has its uses, it can be used in their daily lives, and it has its functions that they can take advantage of, then they would want to purchase or avail of the good or service. Okay, and then you have your different types of demand-based pricing. Again, let's reiterate. Price skimming, price discrimination, and yield management. Price points, psychological pricing, bundle pricing, penetration pricing. Price lining, value-based pricing, geo and premium pricing. And that's it. And then other pricing factors, manufacturing cost, marketplace, competition, market condition, and the quality of the product. Okay. Price skimming, a pricing strategy in which a marketer sets a relatively high at first and then lowers the price over time. It is a temporal version of price discrimination or yield management. It allows the firm to recover its sunk cost quickly before competition steps in and lowers the market price. Oh, I see. Okay, so essentially the main point why they do it is for them to recover their sunk cost. Okay, probably the research and development cost. Okay, instead of spreading it over a long period of time, they just they want to recover it early, so they set the price really high at the beginning. Okay, but they can do that normally if it's the first of its kind and they're introducing it and there is a real need for the product and people are buying it, willing to buy it at any price, right? Price skimming is sometimes referred to as writing down the demand curve. The objective of a price skimming strategy is to capture the consumer surplus. If this is done successfully, then theoretically no customer will pay less for the product than the maximum they are willing to pay. In practice, it is almost impossible for a firm to capture all of this surplus, right? Price discrimination or price differentiation exists when sales of identical goods or services are transacted at different prices from the same provider. Okay. Similar goods but at different prices. Probably, based on relationship na din nung manufacturer or provider with the business, right? Kapag baguhan pa lang, edi syempre mga tipong regular prices pa lang. Pero pag matagal na kayo, meron ng some sort of loyalty, some sort of good relationship, then probably can offer discounts, right? So merong price differentiation dyan. Okay, yield management is the process of understanding, anticipating, and influencing consumer behavior in order to maximize yield or profits from a fixed perishable resource such as airline seats or hotel reservations. Okay, so this is for this particular industry and ito yung specific application niya. As a specific inventory-focused means of revenue management, yield management involves strategic control of inventory to sell it to the right customer at the right time for the right price. Okay, this process can result in price discrimination, where a firm charges customers consuming otherwise identical goods or services a different price for doing so. Yield management is a large revenue generator for several major industries. Robert Crandall, former chairman and CEO of American Airlines, gave yield management its name and has called it the single most important technical development in transportation management since we entered the regulation. So normally applicable for transport groups, transport industries. Okay. Price points are prices at which demand for a given product is supposed to stay relatively high. Psychological pricing or price ending is a marketing practice based on the theory that certain prices have a psychological impact. Retail prices are often expressed as odd prices, as little as a round number, 9.99, 19.99, 19.99, 2.98, okay, things like that. The theory is this drives demand greater than would be expected if consumers were perfectly rational. Psychological pricing is one cause of price points. Okay? That's why they are not, whole numbers. Cleanly strike, 100 pesos, 300. It has to be 99, 299. Product bundling is a marketing strategy that involves offering several products for sale as one combined product. So this strategy is very common in the software business. Bundle a word processor, a spreadsheet database into a single Office suite. You have your Microsoft Office. In the cable television industry, basic cable in the United States generally offers many channels at one price. And in the fast food industry, in which multiple items are combined into a complete meal. Okay, a bundle of products is sometimes referred to as a package deal or a compilation or anthology. Okay, books, stories, essays from different writers, that's an anthology or compilation. And then can also do this for makeup kits, and then you have your, what do you call that, personal hygiene products, and then you also have your grocery products. Things can be combined for a particular purpose, like Christmas packages. Normally they have a spaghetti package, what they call it, salad package, things like that. Penetration pricing is the pricing technique of setting a relatively low initial entry price and then often lower than the eventual market price to attract new customers. So to attract new customers, they are offering it at low prices, and then once they penetrated the market, they start increasing the product. Okay, again, this is applicable normally for products that are truly needed by the market, that, after the market has been penetrated, they would be willing to pay higher price for it, because they can tell that it's worth it. It could be priced higher, and in a way they're wondering why it's priced low. So there are things like that. The strategy works on the expectation that customers will switch to the new brand because of the lower price. Penetration pricing is most commonly associated with a marketing objective of increasing market share or sales volume rather than to make profit in the short term. So in the short term, penetration of the market, getting a larger portion of the market, and then profit would come later, okay, once they have a hold of the market share already. Value-based pricing or value-optimized pricing is a business strategy. It sets prices primarily, but not exclusively, on the value perceived or estimated to the customer rather than on the cost of the product. Okay? It's about the perceived value. How important is it for the customer? Okay, how much would it help them? Okay, the more valuable it is, of course, the higher price you can charge for it. But again, the issue here is getting this to the right customers. Okay, there would be some cost. This is applicable normally for mentorship courses, webinars, or seminars, coaching as well. In a way, there's a randomly set price, value-based pricing, but they do provide it at discounted prices. And then normally it's applicable for people that have a zero background or zero foundation for the particular topic that they are offering. Because for someone who already has the knowledge, it would not provide any value. And they would also think that everything that has been said in the particular course or particular, what do you call this, webinar or training or seminar is, just basics and things that can be studied on their own, could be taken from the internet, things like that, right? And so there are many people who think that coaching courses, mentorship courses are a scam, the fake guru series, right? But there is that. So, be careful. Okay. The goal of value-based pricing is to align a price with the value delivered. You want your customers to say that it's worth it, that the value they've gotten from your product or service is, worth as much as the price that they paid, or it could be worth more. It's based on the notion that a customer receiving high levels of value will pay a higher price than a customer receiving lower levels of value for the same product or service. Okay, it's the same product, but for two different customers, one without knowledge of it and then another who's already, experienced and very knowledgeable on the topic, they would have different perceived value for this product, right? Geo, also called marketing geography or geomarketing, is a discipline within marketing analysis which uses geolocation, geographic information, location, area, okay, in the process of planning and implementation of marketing activities. It can be used in any aspect of the marketing mix, the product, price, promotion, or place. Geo-targeting, okay? With regards to location, again, there are several factors that should be considered. The culture of the people in there, if they are already buying their products or service from an existing provider or if there is none. Okay, the marketing activities would be different if, a particular area, there's no competitor there yet, so it would be much easier for them. In another area where there is a competitor, the people are already availing their service from that, it would be a different story. Okay? They need to create a different marketing strategy for that. And then with regards to pricing, if you would notice, if a particular product is sourced from a different country or a different area, so the transportation cost would play a role in increasing the price of the product, because the cost would also be expensive transporting the product from one place to another. Okay, and then of course there's the particular economic situation of that country, if it's, international business. So you have your branch here in the Philippines and then you have branches in the US, so the pricing would be different because there are different economic situations between these countries, and of course the prices, the wages, the laws and regulations on wages, and also on what was the other one? Forgot. Alright, wages, essentially the wages, and yeah, the cost of living in that particular area. Okay. Next we have competition-based pricing. Competition-based pricing occurs when a company sets a price for its good based on what competitors are selling a similar product for. Okay. If there's an existing competition, of course, it would be hard for you to offer your new product at higher prices. So what you normally do is you offer it at the same price or maybe lower than the competition. Okay. If competitors are pricing their products at a lower price, then it's up to the company to either price their goods at a higher or lower price, all depending on what they want to achieve. Again, they could also, price it higher as long as they're offering, something different, maybe something more better. Okay. One advantage of competitive-based pricing is that it avoids price competition that can damage the company. Okay. Competitive-based pricing. Potential disadvantages include that businesses may need to engage in other tactics to engage customers if the price is not enough of an incentive. Another concern for companies is that this pricing method may barely cover production costs, resulting in low profits. Okay, if they want to be, competitive, and if they are trying to equate their prices with their competitors, then they would have to control their costs. Okay, essentially they need to lower their costs so that they could have a profit on, cost. You have your profit and then the price that's being set by the competition. Another concern is that this pricing method may only cover production costs, resulting in low profits. Competitive-based pricing occurs when a company sets a price for its good based on what competitors are selling a similar product for. Alright? In economics, competition is the rivalry among sellers trying to achieve such goals as increasing profits, market share, and sales volume. By varying the elements of the marketing mix, you have the product, price, promotion, and then you have the place or distribution. Merriam-Webster defines competition in business as the effort of two or more parties acting independently to secure the business of a third party by offering the most favorable terms. So it was described by Adam Smith in The Wealth of Nations, and later economists as allocating productive resources to their most highly valued uses and encouraging efficiency. So again, efficiency is producing more with less resources. Okay? But of course, ensuring quality still. Smith and other classical economists before Cornutt were referring to price and non-price rivalry among producers to sell their goods on best terms by the bidding of buyers, and not necessarily to a large number of sellers or to a market in final equilibrium. Okay? Competitive-based pricing or market-oriented pricing involves setting a price based upon analysis and research compiled from the target market. With competition pricing, a firm will base what they charge on what other firms are charging. This means that marketers will set prices depending on the results of the research. So for instance, if the competitors are pricing their products at a lower price, then it's up to them to either price their goods at a higher or lower price, depending on what the company wants to achieve. Again, if they want to, make the customers think that they are of higher quality by charging higher, then they can do that, right? If they want to be cost leaders by offering lower, then they could also do that. Alright, so you have here a diagram. Competitive market, you have your cost or price, you have the quantity. AC and MC do not cross, so no MES point. Red shaded area indicates the total revenue of selling few products, quantity of products, which is RQ, where RQ is equal to PQ. Okay. Green shady area indicates the total cost of producing quantity, which is total cost of the quantity equals the, what's AC? AC times Q. Status quo pricing, also known as competition pricing, involves maintaining existing prices or basing prices on what other firms are charging. Okay. Maybe later would explain this. One advantage of competitive pricing is that it avoids price competition that can damage the company. Disadvantages include that the businesses have to attract customers in other ways. Since the price will not grab the customers' interest, okay, they can, offer something else. The price may also barely cover production costs, resulting in low profits. Okay, lastly, we have break-even analysis, BEP point, where the total revenue would equal the total cost. Okay, no profit. No loss, no profit. The point where expenses and revenue intersect. Key takeaways. At this point, there is no loss or gain to the company. On a graph, it appears as the point where the cost and revenue curves intersect. In an instance when costs are linear, the break-even point is equal to the fixed cost divided by the contribution margin per unit. The break-even point is one of the simplest yet least used analytical tools in management. It helps to provide a dynamic view of the relationships between sales, cost, and profits. So key terms, we have the price, the amount of a customer pays for the product, expense, spending or consuming expenditures, expenses, often specifically an act of disbursing or spending funds. Okay. Of course, contribution margin, what's that? Revenue minus contribution margin. Selling price minus variable cost is your contribution margin, alright? And then you have your fixed cost, normally not related to the production of the good or service. In business economics, especially cost accounting, the break-even point is the point at which costs or expenses and revenue are equal. Okay, so you have this graph. This is the profit, this is the total cost. Okay, where they interact is the break-even point. If the total cost is higher than, the revenue, then there is a loss. If the revenue is higher than the total cost, then there is profit. Alright? No profit is achieved nor loss incurred at break-even point, although opportunity costs are reconciled and capital receives the risk-adjusted expected return. Shown graphically, it is seen at a point where the total revenue and total cost curves meet. In the linear model, the break-even point is equal to the fixed cost divided by the contribution margin per unit. Okay, essentially, the formula for getting the break-even point is the fixed cost divided by the contribution margin per unit. Okay, example, suppose that if a business sells fewer than 200 tables each month, it will incur a loss, and if it sells more, it will turn a profit. Given this scenario, the company's business managers will need to compile information to determine if they can reasonably manufacture and sell 200 tables per month for them to at least break even. If they think they cannot sell that many, to ensure continued viability, they might try reducing their fixed costs or try reducing their variable costs, essentially reduction in cost. Or they can also consider increasing the selling price of the tables. Any of these would reduce the break-even point, meaning the business would not need to sell so many tables to ensure it could pay its fixed costs. Okay? By inserting different prices into the formula, you will obtain a number on break-even points, one for each possible price point. If in the above example, the firm changes the selling price for its product from $2 to $2.3, then it would have to sell only 589 units to break even rather than 715. Okay, so they don't have all the information here, so let's just assume that this is for a different situation, right? Graphing these results can make them more clear. To do this, draw the total cost curve, showing total costs associated with each possible level of output. The fixed cost curve, showing costs that do not vary with output level. And finally, the various total revenue lines, R1, R2, and R3, showing the total amount of revenue received at each output level given the chosen price point. Okay, later on, we'll be discussing BEP points again. Okay. The break-even point is one of the simplest yet least used analytical tools in management. It helps provide a dynamic view of the relationships between sales, costs, and profits. For an even clearer understanding, break-even sales can be expressed as a percentage of actual sales. By linking the percent to a point during the week or month that a percent of sales might occur, managers can glean when they might expect to break even. So essentially, this is very important, especially for small businesses. They want to ensure that they are at least going to break even, if not, profiting from their endeavors. Of course, no business would want to incur losses. Okay? So they have to make sure that they do compute for their break-even point, so they know how much they needed to sell for a particular period of time. All right. And of course, they need to strategize on how to achieve that. And if they are unable to achieve it for a particular month, then they need to double their efforts the following month. Okay, so that's it for this one. Next video, we'll go over pricing methods pa rin naman, and then we have pricing strategies later on. All right, that's it for this one. Thanks and bye.